expecting to like live off of cash flow from real estate is kind of unrealistic. What's going on, guys? Welcome to today's episode of the Collecting Keys Real Estate Investing Podcast. We're doing a hot intro today. Dylan, let's hear your story.
No, I was just telling you guys when I first got started, and it was so long ago, I forgot about it, was we had a duplex that was one on top of each other, and basically they had separate water heaters. The one on top, the water heater broke essentially, and the upstairs tenant had no idea how to turn off the water. And so it essentially drained and flooded the entire bottom unit. And what's worse is the bottom unit was they didn't speak English. Yeah, and so us trying to coordinate after the fact of getting them, like we had to find somewhere else for them to go, like put them up in a hotel for 3 days, get remediated. The unit was already trashed before that with like roaches and stuff. And so this was just like the second property I ever owned. So it was a quick introduction to how real estate
love real estate. This is so much fun. I'm making $200 a month.
Yeah, right.
Yeah. It was $20,000 insurance claim is what it was.
Oh, did it? Oh, so you had a full on claim.
Yeah, we
did
a claim.
You got it gutted? Did you get it all gutted?
Yeah, we got a whole new bottom unit out of it, which ended up being okay.
Oh,
and
the never happens to Mike and I. Never happens to us.
Well, I think if I made that same claim today, they'd be like, hell no. But this was back in 2018?
We made one insurance claim and we had to fight it for a year and then go to basically small claims court and get they filed collections against us and all sorts of shit. It was like, what the hell? It was wild.
I'm filing a claim right now that's been since May of this past year for a tree fell on a garage. And these tenants were supposed to pay for parking, like off-street parking. And now I can't charge them that because the tree fell on it. Yeah. And I just got approval a couple of days ago.
Isn't that crazy? Where it's like a clean cut, like trees on the garage.
Yeah.
Regardless of what happened, it's right there.
Yeah. They'll just fight it.
They're like, ooh, I don't know. We got to test those shingles for asbestos.
Oh yeah. And they had to send out their own contractor to make sure it was verified, because this thing should be demoed. They're like, oh, we're going to see if we can save it. I'm like, it's off the foundation. Like you're not saving this thing. I don't know what you're trying to do, but
yeah. Just always something. But all right, guys. Well, welcome to today's show. It's a little hot intro. We were coming up on our time. We needed to start, and we wanted to hear the end of Dylan's story. But welcome to Collecting Keys, everybody. If this is your first time here, I am Mike DeHaan here with my co-hosts Dan Austin and Dylan Cook. And this is the show where we teach you to make massive income, not just passive income, with your real estate investing business. And on these Wednesday shows, we talk about what's going on in our businesses, what's going on in the real estate news in general, and we talk about whatever else we feel like this week. Before the show, we always have like a little pre-show chat, and we all have lots of drama going on. Dylan has his insurance situation that he's dealing with right now. I just got off the phone with my property manager, and they're turning one of my rental units. And tell you what, guys, this is why I'm getting out of the rental game. These people were in my property for not quite 5 years, just under 5 years. How the fuck does somebody do $20,000 worth of damage?
What property was this? Was this?
It's my triplex. But
I always got a problem,
dude. Like, it doesn't make any sense. Like, I redid the unit when they moved in, when I bought it. That was like the one unit that was empty. It became empty because I took the tenant that was in there, moved them into a unit that had already been redone by the previous owner. And so this unit, I remodeled it, put someone in there. I don't even understand how, like, the dumb shit, broken windows, broken flooring, like water issues, like all. I'm like, how? I've lived in properties for longer than that. Like when I moved out of my old primary and I sold it, I'd lived there for 5 years. We didn't do anything. We just left.
You left.
If anything, you probably made it better.
Dude,
I was just down at one of my student rentals, which you would think would be like just beat the shit. That when did I remodel that? Like 2018, brand new remodel.
Yeah,
just went in there. Was that 6 years ago?
Yeah,
and it's had a lot of young kids go through it. It's in good condition. Like they've taken good care of it. Like it's like there's not anything crazy in there. Like so, I don't understand how some of these people just trash
college
units.
Kids.
Yeah, they're college kids.
Yeah, I would expect them to trash it, right?
Yeah,
like
you better knock on wood, Dan, because
No shit.
I think the college houses that I was in, I don't know if we left them in better shape.
Well, you went to probably the poor state school. This is a private school for elite Americans.
Yeah, totally.
Oh, only Americans?
The little tiny religious school. Yeah, the little tiny religious school that's not even accredited anymore.
Yeah. There's like 2,000 students that go there, but their parents are rich.
Yeah.
they pay good rent.
My biggest thing with like tenants and stuff is like, I think I put this on my Instagram the other day. The guy's like, "Oh, I've had a leak in my vanity." I'm like, "Okay, fine. You know, how long has it been going on? We'll come fix it. Take a look at it." "Oh, like 6 months." I'm like, "Bro, I can't fix it if I don't know what's happening."
Yeah.
Like, so and it was like black mold
vanity
behind this vanity because it's been going on for like it was a small drip, but still 6 months of a continuous drip is a lot.
Yeah,
that's crazy.
It is a lot. Yeah, you got to put in your leases that if they don't immediately tell you about water damage, that they have to pay for it.
Yeah, I think I even have something like that in there, but
it's never worth it because it's like a $350 vanity and like $200 for a guy to come in. So you just do it, but it's like it's so annoying.
Yeah, I mean, but it's like it's nonstop too. Like I can think of, I don't know, count on one or two hands the number of tenant turns where I haven't like walked in afterwards or like heard from my property manager been like, what happened? Like I don't understand. It's happened in A-class properties, in C-class properties. Honestly, I think the only times where it's been kind of like, I would say safer or like the best bet is if it's like a B or C class property with like an older tenant, because like just their slower movement patterns, they just don't do as much outrageous shit, I guess.
What about these landlords we buy shit from that have like, they're like, wow, we had this tenant for 15 years.
It's in perfect condition. They're the nicest people. I'm like, yeah, you don't know that they're breeding.
Yeah, but I'm just saying they don't have $20,000 turnovers.
They don't ever put $20,000 into their own property.
Maybe they've got something there. Maybe they have the system figured out.
And they're always like, I haven't increased rent in that entire time. Yeah. So but then what you say that, Dan, they never had $3,000 turnover. Instead, they sell the property to us for 60 cents on the dollar. Yeah. And that's all of those turnovers that they should have done.
They bought that triplex for $14,000 in 1964. They don't care. They're like, yeah, I'm winning.
I mean, I guess they could have sold it for 400. Instead, they sell it to us for 175.
Yeah,
I will say a lot of like millennial generation, and then whoever old Dan is.
Wow.
But anyway,
by the way, we got Dylan and Mike, the Gen Zs over here.
Yeah, well, Dan fought for our freedom. Thank you for your service, Dan. The veteran.
Dan. But anyway, a lot of the baby boomers I talk to, like because millennials get a bad rep for being lazy or whatever, they're the biggest slumlords. Some of the baby boomers I talk to.
Oh,
they
I
don't
put
millennials. 2 cents.
Yeah.
No. Yeah. They don't put 2 cents in their properties, and they don't give a shit about the people that live there anyway.
It's because those tenants, if they would just pull their bootstraps up and get to work, they would not be tenants. Like
guys are looking at it the wrong way. You guys are looking at it the wrong way. They grew up with parents that lived in the Depression, so they're just thrifty. They're just being thrifty.
Right. God. Right. I mean, it is, but it is like it's a constant thing, though, right? Like it's funny because if you listen back at the old, like bigger pocket sort of era real estate people, they always have like these numbers for how they calculate CapEx, maintenance, all these different things. I'm pretty sure that their numbers that they came up with were inaccurate back then. And they're definitely inaccurate now, especially with how cost of materials, cost of labor, and have everything.
It's a weird period,
and like it's hard to like know what the actual like net return is going to be on your real estate going into the future. Right. And so like, it kind of comes down to like, what is truly the best sort of long-term investing strategy that you can have? Like if you're looking towards retirement, cause like, you guys have heard about like the 4% rule, that's like the old, like financial independence thing where they say, if you can save up like $1 million, you can live off of like 4% of that and basically get 40 grand a year. And the market is supposed to grow enough that basically that's always replenishing, right?
Keep up with the rest of it goes basically to inflation, assuming a 3% inflation rule, average return of 7%. Is that the rule based on?
It's pretty much like the guideline that they're following off. But they looked off, the 4% rule is based off a study they did from 1926 to 1976.
Yeah.
And it came out in the 90s. But they basically said no matter the peaks, the troughs, just take take your averages, but take your expenses. So like, if you live off 50K a year, you're going to need 4X that to retire on. So $2 million.
Well, and obviously like that's not that much money anymore these days because we've had things that have accelerated inflation and all these different things. You know, and I would say one of like the knocks that people typically have against stocks and bonds is that real estate allows you to use leverage. It has appreciation, it has all these other things. But if you're starting to look at the massive increase in renovation costs, right, and just like the cost to like maintain the properties, and like the fact that it's such a recurring thing, or so it seems.
Yeah.
Is real estate actually that much better than just putting it into the market, or like, you know, trying to rely on like the 4% rule? I don't know. Like I know we all, like all of us on the show, have experienced very good wealth generation from appreciating properties. But that's also because we were doing it over the past couple of years where properties were appreciating a shit ton. And we can't necessarily rely on that again in the future.
Equities also raised a shit ton during that same time period.
Exactly. Yeah.
Well, they always, so we know that it's any asset really, in my opinion, is inflation protected, right? Because it goes up with value. And so real estate in particular, because it's such a slow moving asset, is a really good, you know, inflation hedge, right? If you look, I pulled this up while we were talking. If you look at it, to answer your question, Mike, the S&P 500 over the last 30 years, which is I think a very statistically relevant time frame. It's not going back 100, but the last 30 returned an average of 10.52% a year. That's pretty freaking awesome.
Yeah.
That's solid. And you didn't do anything. You just let it
just
sit there.
And kept compounding. Yep.
You didn't need to know how to invest. You didn't need to do any toilet replacements or whatever the hell you guys do in real estate. You get 10.5%. So that's pretty solid. But I think over that same time period, if I had to guess, real estate would have given you as a landlord, like owning it physically yourself, would have given you a better return if you calculate all the benefits of real estate. However, you would have had to work for it.
Well, it's also going to be dependent on if you're in the Bay Area versus you're in bumfuck Kansas.
Maybe,
right?
Right. But
absolutely.
I think the tax benefit, benefit, well, yes, but can you buy a house in San Francisco right now and rent it out and cash flow it? No. So you have the counter to that. You can go to buttfuck Arkansas or wherever you just said, Kansas. Is that the state?
One of those like middle ones that
one of the square ones.
Yeah.
But you could have that whole period of time. You remember when we were first working together, Mike, like guys were getting like 3 and 4% rule deals in those markets off the MLS. So the cash flow inversely is better in that market, and you needed less capital up front to get into it. So I guess every market has its own different benefits. Like I personally would have rather owned something in San Francisco for the last 30 years than I would in Arkansas. Yeah,
because it's like tripled in value, but then it still goes back to the point of maintaining the property, right? So you're getting a property that cash flows $800 a month in one of those markets. Okay. You know, every 2 years you have to spend $20,000 to renovate that property. That's going to be close to all the cash flow that you collected.
Yeah. They're quite possibly.
Yeah, but also hold on. You can't buy $100 worth of stock for $20 like you do in real estate. You also can't burr a stock where you can force appreciate and basically refinance the stock, right? So there's like two things going for you. But the biggest thing, I think, even with rentals nowadays, like the burr strategy, the biggest thing is velocity of money. Yes, everyone understands that. The second biggest thing is the fact that you don't have CapEx items for 10 to 15 years.
Totally.
That's the other biggest problem.
Yeah.
Or biggest like solution in my opinion.
Yeah. I mean, I really have bought into this mantra that you see some of the people putting out there now that expecting to like live off of cash flow from real estate is kind of unrealistic. Like cash flow is like ultimately a defensive metric to maintain your asset that you are hoping is going to increase in value and that you're leveraging debt to pay down.
So here, let me ask you that. Like, let's talk about that because this is interesting because I know people that make a shit ton of money on cash flow on properties right
Allegedly.
in the moment. In the moment. So does that play out over the long term where over 30 years of ownership, you have to own it that long? Or is that actually, is that a consequence? Because I kind of strongly believe that if you properly burr a property, like you buy it, then you renovate it and make it nice and somewhat sturdy. So it's not going to be a piece of shit, you know, in 2 years when you do a turnover, but you renovate it, make it nice, cash all your money out. And then you're able to avoid CapEx and operating expenses for like 5 to 7 years. You can kind of strip everything out of that property, but you need to sell it before you have to do that new cycle of replacements.
But then you just do the same thing with the next property.
Yeah.
Yes, absolutely. But you can do that to that next property, refinance it again and keep burning and selling it. And also you get tired of a property after a while, don't you? I mean, you're just bored with it. So you want to sell it after 5 to 7 years. But the idea being, in reality, I'm being facetious, but in reality is like you ideally are upgrading to something bigger, to a bigger asset as you're going. If you're selling these properties, you eventually kind of upgrade into a different asset, and that's bigger dollar amount, and then eventually maybe into stuff that's even more passive.
Yeah. But I mean, I still think though, you say they make bigger cash flow in the moment. I mean, I think that ultimately gets taken away though, once you're having to do those repairs and everything else. Like it'll end up being in a 1 year time horizon, it might be a net huge positive, right? This is what like a lot of the Airbnb people were super into this. Now all those Airbnb people that were printing money over the past 2 years are losing their ass because they're selling their properties at losses.
They're holding the bag,
right?
But
and the Airbnb is a one exit, like not the traditional, like when people talk about real estate as passive investments, like that's not the avenue or their vehicle that they're using.
Yeah.
And I'm just fighting back because I'm kind of defending my own strategy. You know, I own 43 units now, and I have the intentions of someday paying these things off. If each unit, let's say I'm up to 50 units and I don't really grow that much, each one rents for an average of $50 or $1,000 a month. That's $50K a month with no mortgage. So I got taxes, insurance, utilities, and then set asides.
Yeah.
Right. So I just have a hard time believing that I couldn't have a very good lifestyle.
Let's do the math.
I think you definitely could, but it's all about like, is that the best strategy? What's your best, velocity of money? Do you care? Right. Because that's the other thing too, is some people like stocks. Like Dan's father-in-law fucking loves the stock market. Yeah. Right. That's like his game that he plays. There's people that
never did real estate. Just
there's landlords or, people that just love real estate and that's like their thing. But if you're trying to figure out what the best way is, what is it? And so Dan, go ahead, do the math.
I was going to say, so if you were going to make $50K a month, what do you think the gross value of all those paid off properties would be in your market?
Probably around 5.5 to 6 million.
Okay.
So you're making less than a 10% return.
5.5 to 6 million, and I would guess your net on that's probably 50% margin. So if you make 50K,
say it's probably a little bit more north if you have any mortgages. Yeah, 60%.
60%.
Right.
Yeah, so 60 times 5, that's 30,000. So 360 grand. Yeah, I think you could make more money in the stock market. You can make $500,000 a year if it just put in the S&P 500. If that's your total strategy, you're not getting tax benefit with that. But you're also not getting the benefit of leverage because you said they're paid off.
You're also not having the risk of, a storm blowing over one of your properties and you're having to fix it. Right?
You also don't have the risk of some bullshit election that's going to sink your portfolio in the mean term. And so now the one thing I don't like about the 4% rule, say you're making $100,000 a year off of the 4% rule. That's assuming it's 4% of your portfolio. Well, if it's a bad year and that you depress your portfolio from say 4 million or 3 million down to 1 million, like now your 4% is of 1 million instead of 3 million like you had planned and projected. So you really have to kind of actually reduce that diversity of your stocks to bonds, right? To more fixed income.
Yeah. And as you get older, like things change. Like you're going to probably be more bond heavy the older you are. But I mean, there's certainly
more
dynamics
fixed income.
to this.
So then 10.5% isn't. So I'm just kind of going back on what I said. So maybe your actual growth is like 7% because you have to go more bonds so that your 4% doesn't reduce to 40 grand.
Yeah. I mean, which created this massive like calculus problem. Everyone's completely lost. We'll have to turn this into an infographic.
I honestly think here's my opinion on this kind of conversation though, is if you are like dotting your T's and whatever the hell it is, crossing your I's.
You did go to public school, didn't you?
Rural public school too for Dan.
But you know what I mean? Like is like if you're really fine, like doing this with like a fine tooth comb, and you're like, I think I can make it. Just make a shit ton more money. Don't worry about it. To where it's like if you want to be diversified amongst real estate, Dylan, real estate's not your only asset, right? You got crypto, and I'm assuming, so you're well diversified, and so like if that for you is a strategy, just make more money. Like if you're like literally like really penny pinching to get down to like, okay, I think I can make enough to retire. Like you're going to have so many more risks, to that portfolio. Like it's not weatherproof at all. In my opinion.
And there's always going to be risks in everything regardless. Right. And I think it's important to understand that. And also too, if your goal is absolute maximum gains, then one thing that's going to do that is yourself and your own business.
Just to backpedal a little bit, I was actually having this discussion on my Go pod call today. One of the guys was like, I'm actually a little bit worried about having all of my real estate concentrated in one market. What if that one market goes upside down? Or like they have political things that happen that ruin the investment. So he's like talking about putting, dollars somewhere else.
The interesting thing is I feel like you can argue against anything, because I would argue that you're better off concentrating in a market, assuming it's not a small market that has one major employer.
Yeah.
Like Cincinnati. I feel like you would be safe in Cincinnati if all your stuff was there. Cincinnati's not going away.
Yeah, I feel safe here, but
Yeah.
I hadn't even considered that as a thought. But it was a good discussion that we had today.
Yeah.
But yeah, we have a ton of S&P 500.
I think you can niche down in a market and gain a lot of efficiencies by having all your properties in one location, where you can have one asset or one property manager running it all for you. You have the same construction people, you have the same costs, everything's the same. I just feel like you're going to be way better off than sprinkling it across 10 different markets, because you want diversity. That's where I think people just like shoot themselves in the foot by trying to like follow some mythical metrics of diversity that they went to, an estate planning convention, and some told them that they need $400 million in infinite banking, life insurance, and this and that. And you're like, okay.
Yeah, there's an economy of scale that happens with everything, right? You get compound interest, not only on the growth, but also on the systems and leverage that you can get.
Yeah, knowledge too.
The knowledge, exactly. And if somebody owns a little bit of stocks, a little bit of real estate, like I said, a little bit of insurance, they're going to be diversified. Like they will face less downside risk if one of them goes sideways, but you're going to have much less compound growth as things tend to get better.
We kind of touched on it a minute ago, but I think the real benefit of this, like you're talking about selling your entire portfolio, Mike, like you're not saying you don't like real estate. You're saying that you were able to make more income with that investment, that equity at this point in time elsewhere. And also why we are huge on the whole massive income concept, and like learning to wholesale and learning to flip and learning to use real estate in different ways to produce active income, because it's so much easier to make $100,000 in wholesale. I mean, we had, what did Carl say? What are his net wholesale fees in the last 6 weeks?
6 weeks, almost 300 grand.
That's freaking nuts, dude.
Yeah,
it's like in like 6 weeks, right? So can you do that with can you pivot your portfolio right now and make 300 more thousand? No.
Absolutely not.
You can take some of those wholesale fees, and if you choose to invest it in real estate, go ahead. But the active income portion, like the things that you can do during the day, why your portfolio is doing whatever the hell it is the flipping, is the wholesaling, and why you want to stay interested in real estate, because then you also become an expert. So when you see that really good deal you can't say no to, you can buy it. You can still take it down.
Absolutely.
The biggest reason why I have even a little bit of wealth right now is because I've made $100,000 plus since I've been 24 years old. And I've lived underneath my means. Both my rentals are from 2021 or later, 2022 or later.
Yeah. So recent.
Yeah.
But it's because you've been actively working, whether that was in your pharmacy gig or as a wholesaler flipper, like working your tail off. It hasn't been easy. Like you work a lot, you get your shit done, and you're kind of.
I'm just saying it's 7 years of a larger income. And
Obviously
living below our means is what's been the biggest propellant.
Well, and that's a super underrated comment too, right? And like I mean, for me as well, I left my career in engineering in 2018. The reason I was able to do that was because I had an engineering salary for 5 years. My wife had been working for 5 years, and we had been living significantly below our means, very intentionally, not because I wanted to leave my job, but because from like my personality, I was like, I don't understand how people spend all of this money. Like they're not setting anything up. So I already had
rich.
Yeah. So I had $100,000 in a 401k. I had $100,000 in a savings account. Right. I had a taxable investment account that had like 60 grand in it. I was able to take that leap because I had saved up a shit ton of money in 5 years.
Especially when you're young. When you're young like that and you're single, single without kids or whatever, married, whatever, dual income, like there's so much power with that. Like you can just dig in. Like what else are you going to do?
So you say that, Dan, but like some of the other younger engineers that I would work with, they didn't understand how I spent so little money. And I didn't understand how they spent so much, because it wasn't like I was like, living off of rice and beans, but I cooked a lot of my own food. Like when we did activities, I don't know, our taste was to do like free activities. So like we would go hiking, we would do outdoor stuff. We would go, if we went to like a concert or something, like, I don't know, I'm not a Taylor Swift guy. I wasn't dropping $2,000 to go to a fucking concert. I'm a punk rock guy. Right. So that's like where I went, where tickets were $15.
Yeah.
And even like we had like rent, we rented an apartment that was significantly less than we could have probably gotten, but we didn't need more. I don't know. It's just it's a mindset.
You also
right?
didn't drive like a new Benz or something. Like, you didn't buy a new car.
Right.
You didn't like
Yeah.
buy the
I did.
house.
I did buy the new car when I got my job at Boeing. That was stupid. I bought a brand new BMW.
He's
That
still
was
paying
dumb.
for
See, I
it.
didn't know that.
Yeah. He's still paying for it with his Subaru Crosstrek.
Yeah, that was my one big financial blight. But I got like a signing bonus and I got a huge pay increase, so I could afford it without affecting my savings rate, right?
Yeah.
And then even like when I was at Boeing, like the first year I had like, because of the union stuff, I got like a $15,000 bonus, but I didn't spend any of that. I just put it all into stocks.
Yeah. Yep.
Right. And that's what sort of like sets you up to be able to, take like the bigger risks. But my whole point though, when it comes to business, one of the challenging parts of being a business owner, and Dylan, I know you'll sympathize with this, is learning how to pay yourself, right? Or like what reasonably makes sense. I am in business ventures where I have partners. We all have like different sort of financial situations, different goals on our income. And ultimately, like I have long-term financial security with my rentals. Like I know that if I held on to them in X amount of years, it can be my retirement, whatever. My current thesis with it is if I was to sell all of my properties, I'll have a few $1,000,000 in cash. I can put that either into my hard money lending company or into different debt funds where I will get literal guaranteed cash returns that I will then be able to use to pay all of my bills. And I no longer have to feel like I am stressing my companies by wanting to pay myself the salary that I want to be paid. Okay. And I'll be happy taking a super menial salary and then just get paid out in quarterly distributions like Dan and I have done without needing to have like this psychological, like, well, my bank accounts are going down because we are, Dan and I pay ourselves like, what, $5,000 a month or whatever out of our business.
It's our salaries. Right? We're balling.
Yeah. And so I'll be able to reinvest more, which will ultimately lead to longer growth and like bigger growth in the business. And then, also larger chunks that we'll be able to pay out because I'm not needing to take more money from the business to pay my own bills.
Yep. You're just taking your equity and you're shifting it so it's in a more of a cash flow safe position.
Exactly.
So that you can essentially invest that money
totally
into yourself and your business.
Yeah. And then you have the opportunity to be more like, not risky, but like take those chances, just like you were at the beginning because you had a pile of cash. It's the same thing, just a bit later on.
Yeah,
exactly. Right.
Different pile of cash.
It is a different pile of cash, and I'm giving up future millions in my rentals to bet on myself. Right. And there's the saying, I've seen it get like reshared on Instagram a couple of times, that become a millionaire, you have to be willing to bet thousands. To become like a decamillionaire, you have to be willing to bet millions. Right. And I'm in that phase where I'm like, that's fine. Like I'll do that. Yeah. Yep. And I will give up my sort of like guaranteed future millions in my rentals to have more financial security now so I can bet more on myself and my business. Worst case scenario, I still have my principal. And, also too, if I'm still paying myself out of the business, like we've been doing, and I live off of that for the most part, then I can just compound that cash flow that I pull out of these debt funds and things back into those if I want to.
Yep.
And it's like a fixed number, right? I'm not having to worry about the variation. I'm not having to worry about like suddenly having to do $20,000, put in $20,000 to fix up this freaking rental unit.
Yeah.
Right.
That
it just seems dumb. Like I just
put 10 grand on a new roof too. Like, so, the shit pops up.
Like all the time, and you can't control that. And so like my view of security is like, what if I just didn't have that and I can just, compound it as I want to, or live off it.
So this is good. Yeah. The other thing I just thought of is the debt funds or what you're doing makes sense. But to get like cash flow from like a stock portfolio, like something that pays like dividends, you have to have like, it's based on a dividend yield, but you need like $8 million to get like what the equivalent of this debt fund would be, like for like $2 million, right? Like it's a big difference in the amount of money needed for that cash flow.
It is. Yeah. And the debt funds and things like that are technically slightly like more risky, slightly more work. You also have to be an accredited investor to invest in a lot of them. So if you are somebody that, does not have the net worth or income requirement for that, you don't get the same opportunities. But
I would say the other flip side of that is the debt fund, your principal isn't growing, where even if it's a dividend fund, your principal's still going to grow at like a 5, 6, 7%.
And that's a trade-off. Yep. But yeah, so that's kind of my whole thought around it, and over like the long term too. When it comes to like retirement and everything else, I don't know, like maybe it's my generation, my risk profile. I'm not like, I'll say as like an entrepreneur, I don't have this like belief that I will get to 65 and be like, well, I guess I'm going to be done working now. Mainly just because like, I don't know, it doesn't
deals.
Yeah. That doesn't run in my family. Like my parents are quote unquote retired, but like, my dad's about, he's turning 80 this next year. he's still doing deals like all the time. Like that's his thing. Like that's how he like keeps young. He just does deals while he's traveling.
Yeah.
You know,
and it's a different position. He's not sitting there plunging toilets, or he's not starting out doing deals as a new landlord, which that's a young person's game. He's now transitioned his wealth to where he's doing deals, or he's using other people to allocate his money so that he doesn't have to physically go and swing a hammer or something crazy.
Exactly. You know, and I guess I came from an entrepreneurial family, and so I never was around like my parents, they just moved to a condo in St. George and they play pickleball 5 days a week and
golf,
then they golf and
bingo.
I just have that same desire.
Well, like I know this has been said in other podcasts, but it's true. It's like basically anyone who can achieve financial independence at a relatively young age, 30s, 40s, whatever, is not going to be the same person that just sips pina coladas on the beach for 30 years.
No,
it's just not in your blood.
Yeah.
No.
Like I can't even help it, you know. Like it's to the point now that pretty much everything I do, I'm always thinking about business at some capacity. You know?
It's funny, everywhere. Mike, you said paying yourself, and I went back to I have like this break even thing for my business, and I just started paying myself more than you guys, $6,000 a month.
You're balling.
Yeah. With the acquisitions or with the executive assistant I just hired and everything, so it's about just under $15K a month.
That's your nut you got to cover.
Yeah, just to break even on a monthly basis.
Yeah,
and so that's if it's a small wholesale fee, that's 1 to 2 deals a month just to break even. That anything on top of that, with scale, you can make a lot of money.
Yeah,
there's so much value in what you said there too, because Mike and I, we didn't really figure this whole pay yourself out for a bit, but now we look at just like you said, your nuts 15, ours is a little bit different, but like that's just built in. And it's an auto draft once a month, goes out of the business account into our personal accounts. And it's not even a thought. It's just like, that's an operating cost. But before you do that, you're not thinking that way. You're just like, oh, my monthly nuts, for in your case, 9,000. Well, just make it 15 and pay yourself and stop struggling to do it. You know what I mean?
It's even so hard to do, especially at the beginning. Like if you haven't even proven to yourself that you can do this and make deals consistently month over month, it's very difficult to do.
Absolutely.
And I just got here and I've been doing this for almost 3 years.
Well, and we started out, I thought it was 3, maybe it was 2, and then we bumped to 3. I can't remember what we did. Mike and I was like, okay, we got to the point to where like, dude, we're making a lot of money and we're not like paying ourselves directly, because we would just reinvest it. We'd buy another property. We'd do this, we'd do that. And so once you get to the point to where you're consistently making money, give yourself, even if it's $2,000, just do it. And then that literally becomes your norm. It just does.
I'll confess to something for a second. So I had it set up to like auto withdrawal, but it just went to another business account. So like it didn't even matter. It's in the same freaking area. But now I actually make it go to my personal account.
There you go.
That's funny.
Of course you did. Like it just goes to my business savings account.
Yeah, it did. It was was supposed to be that profit first model where you had you have an income account, a profit account, whatever. But
yeah, I mean, ultimately, I think that if you want like true financial freedom, right? Like to the point where your bills are being paid on autopilot, there's different ways you can approach it. And I would say too, there's probably a little bit of trade-off that you can make, because the way that's probably going to pay you the most like cash out is not going to necessarily be the way that contributes to like the most growth, and like vice versa. You just have to sort of figure out what that looks like for you and what kind of makes sense. And for some people, that's all in on real estate. For some people, that's all in on dividend stocks. For some people, it's all in on crypto. For some people, that's like zero investment and it's all in on business, and there's no right or wrong answer. You just kind of have to figure out what your ideal situation looks like. This has come up at a couple of abundance events a few times. And I've told people that like because we always talk about our horizontal income goals. And what I typically tell people is my goal is to have $2 million that are in a pref that is paying me, 10 to 11% per year. And I will be able to live off that money extremely comfortably because I don't really have a desire to elevate my lifestyle in different ways. And that would have me making, just south of 20 grand a month. And it's also something that I could very reasonably do like relatively quickly.
Sure.
Right. And then my horizontal income goals are met. And then all the extra money that I make, I can either throw it into that machine to make more guaranteed horizontal income because I'm getting a pref out of something, or I can go and invest it into my business because it makes sense to do that. And I'm hoping to, increase that money exponentially because like, especially like with the wholesale business, I was going through our numbers the other day, Dan, And our current return on ad spend for our wholesale business in Spokane is 8x.
It's pretty good.
That's really good.
There's no passive investment vehicle that's going to give you an 8x return.
Yeah,
ever.
on your money. 800% for people that are percentage.
Yeah, it's like 8.3 times every money we put into marketing goes out. And we have a partnership with that, so that sort of splits it out. But either way, like that's a pretty dang good return that we can rely on.
Totally.
So
and I would just implore like people listening too, is like what you said is you got to figure out what you want. Don't just listen to what other people are doing and make that your like goal. Just use it to educate yourself and then figure out truly what do you want? Where are you at in life? How old are you? Where are you at in your investment cycle of like your investment career, your real estate career? Like, what do you want to do? If it's truly just to have passive income and go golfing every day, then figure out ways that you can do that are within your means in this moment in time. Like, what skills do you have that you can do that? Mm-hmm. If it's going to be just wholesaling and making 20, 25, 30 grand a month net, do that. If you don't have $2 million to plug away into a debt fund, don't try to make $2 million just to do that, because that's not necessarily the right thing for you at this point in time. It's the right thing for Mike.
Don't you guys know a couple that like they like flip 2 houses a year and they're like happy? That's like their whole business model.
We've had buyers like that before. Like there was one buyer. Yeah, one buyer in particular that we sold. I guess a deal to twice. It's like a dad and a son. And that's their whole thing is they go and they flip like 2 houses, maybe 3, and then they just spend the entire rest of the time like at the lake. Yeah. And that's
what works for them. That's the most
redneck
important thing.
Hillbilly stuff, probably.
Yeah, probably whatever their ancestral family's doing up in North Idaho. But So, anyways, so we're gonna finish on that comment.
Yeah,
we gotta finish something.
You said it.
I don't have much else past that.
Okay. So
no, I'm good.
Yeah. Well, sorry, North Idaho folks.
Yeah, sorry, North Idaho folks, but there's a reason that we call you sister fucker country. And that's Dan's words before the show.
I never heard that. I was born in Idaho. I'm one of those sister fuckers.
We'll finish on that one instead.
You heard it here first.
Yeah, you heard it here first. All right, guys. Well, thanks for listening to today's show. I would love to hear your guys' thoughts on asset allocation, though, because I think it is a very interesting thing that isn't necessarily discussed in an educated way. And it wasn't discussed educated here either. So come and teach us your thoughts on it. Maybe you got a better view on everything. So anyways, guys, thanks for listening, and we'll talk to you guys next week.
See ya.